The market right now is acting like a guy who just bought bottle service while his credit card is literally smoking in his pocket. And everyone keeps saying the same thing. It's AI. No, it's rate cuts. No, it's the soft landing. But here's my problem. Something feels off about 2026. And it's not AI. It's the bill. Not the exciting bill, the boring bill. The one that shows up after the party. History doesn't repeat, it remixes, and 2026 feels like a sequel to two movies you've already seen. Movie number 1, 1999. Stocks ripping, narratives everywhere, everyone's a genius. Movie number 2, 2006. Not the crash year, the year before. Everything looked fine, until you realize the entire system was built on one magical assumption. We can refinance later. That's the real drug. Not AI, not crypto, not meme stocks. It's the ability to hit extend payment on the entire economy. And for a long time that worked because money was basically free. Then 2022 showed up like a bouncer. No more freebies. Now it's 2026, and the sequel is hitting the part where the characters realize the tab is due. Let's put numbers on the monster under the bed. First, the market. The S&P 500 just cracked 7,000 for the first time. That's the headline. The fine print? The S&P 500's forward PE is around 22.4x in late January 2026. That's not .com 90x earnings insane, but it's expensive enough that you need everything to go right. Now zoom in. The Magnificent Seven are about 33.8% of the entire S&P 500, one-third of the index, 7 stocks. So if you're diversified in the S&P, you're basically wearing a diversified outfit while carrying one emotional support tech stock in a baby carrier. Okay, that's the market. Now here's the villain. Debt, rolling debt, refinancing debt. As of early January 2026, total U.S. gross national debt is about $38.43 trillion, and it's been rising at roughly $8.03 billion per day over the past year. That's not a lot. That's your calculator gives up territory. Now the kicker. Interest. In fiscal year 2025, interest payments were about $970 billion. And the Treasury was paying roughly $92 billion per month in net interest in the final 3 months of 2025, per reporting that cited CBO. So the U.S. government is basically paying a luxury car payment every month, forever, and the car is a debt pile. And rates are still not free money. The Fed is sitting around 3.50% through 3.75%, so the refinance button is still sticky. Now add the private sector. In high yield alone, one dataset shows $79.2 billion maturing in 2026 and $140.3 billion in 2027, subset of publicly traded HY issuers. And PitchBook LCD has a bigger monster later, about $580 billion of leveraged loans and $525 billion of high-yield bonds maturing between 2027 and 2029. That's the maturity wall. That's the "we'll refinance later" moment meeting reality. And then we get to commercial real estate. National office vacancy was 18.4% in December 2025. There's still nearly 31 million square feet under construction, and S&P Global has warned that the commercial real estate maturity wall grows to nearly $1 trillion in 2025 and peaks in 2027 and about $1.26 trillion. So we've got expensive-ish equities, extreme index concentration, government debt snowballing, interest costs approaching absurd, corporate maturities stacking up, CRE refinancing staring into the abyss. And that's why 2026 feels off, because the story isn't AI. The story is, can everyone roll their debt without blowing up earnings? So what does this mean for you? It means the market has become a magic show, and the trick is simple. Keep confidence high,
because confidence is the only thing that makes refinancing easy. If the economy stays stable and rates drift lower, this can be fine. That's the soft landing script. But if something cracks, credit tightens, earnings wobble, or refinancing gets more expensive, the whole market doesn't need to collapse, it just needs to reprice. Because at 22.4 forward earnings, you're paying up for a clean future. And with 33.8% of the index sitting in 7 names, a normal pullback in those names can make the entire market look sick. This is how the nothing happened becomes, why is my portfolio down 18%? Not because the world ended, because the market is top-heavy and debt-heavy, and refinancing is a vibes-based business. Also, quick side note, gold. In 2024, central banks bought 1,045 tons of gold. That's not doomsday, that's "I'd like options, please." And by late January 2026, gold has been trading above $5,100 per ounce in some reports. Again, not proof of collapse, just proof that the adults in the room are quietly hedging. So here's the balanced truth. 2026 might be totally fine if earnings stay strong, if rates ease gradually, if the refinancing machine keeps humming. But the reason it feels off is because the system is more fragile than the headlines suggest. Not fragile like apocalypse, fragile like a guy doing great, until you ask to see his bank account. The smart move isn't panic, and it isn't blind faith. It's risk management. Own businesses with strong balance sheets. Don't confuse S&P 500 with diversified. Keep dry powder, and don't let a narrative, even a good one, do your thinking for you. Because in markets, the most dangerous words are never "AI is a bubble." The most dangerous words are "we'll refinance later."